Mark Zuckerberg pays a 15% effective tax rate on his $150 billion fortune, while the software engineers who built Facebook for him pay 48% on their $300,000 salaries. And this isn't illegal tax evasion. This is a completely legal loophole called the qualified dividend tax rate that allows billionaire company founders to pay less than half the tax rate of their own employees. And by the end of this video, you'll understand exactly how this dividend trick works, why Mark Zuckerberg, who is worth $150 billion, pays a lower tax rate than someone making $300,000 per year at the company he founded, why you can't use this same loophole even if you work at Meta and own stock, and why this system is deliberately designed to ensure that people who own companies pay far less tax than people who work for companies, because once you understand that the tax code isn't broken but is actually working, exactly as designed to benefit founders and punish workers, you'll understand why wealth inequality keeps accelerating and why no matter how high your salary goes, you'll never catch up to someone who owns equity in a company. Before we explain the dividend loophole, let me show you the exact math of how much more a Facebook engineer pays in taxes compared to Mark Zuckerberg, and this comparison will make you understand why the system is rigged against wage earners. A senior software engineer at Meta, which is what Facebook is now called, makes approximately $300,000 per year in total compensation, including salary and stock, and here's how that engineer's taxes break down. Federal income tax on $300,000 is 35% marginal rate, which works out to about $105,000 after deductions and credits. California state income tax, because Meta headquarters is in Menlo Park, California, is 13.3% on income over $300,000, which is another $40,000. Medicare tax is 1.45% on all income with no cap, which is $4,350. Social Security tax is 6.2%, but only up to the wage base of $160,000, so that's another $9,920. Add it all up, and this engineer pays $159,270 in total taxes on $300,000 income, which is an effective rate of 53%, meaning this engineer takes home $140,730 after taxes, less than half of what they earned. Now here's what Mark Zuckerberg pays on the same $300,000, except Zuckerberg doesn't earn $300,000. He sells $300,000 worth of Meta stock when he needs money. Mark Zuckerberg's official salary from Meta is $1 per year. Yes, literally $1. So he pays almost no ordinary income tax on salary. Instead, when Zuckerberg needs money, he sells Meta stock. And because he's owned that stock since he founded Facebook, when he sells it, the profit is treated as long-term capital gains, and long-term capital gains are taxed at a maximum of 20% federal. And because he makes over $200,000 per year, he also pays the 3.8% net investment income tax, so his total federal rate is 23.8%, and California taxes capital gains as ordinary income, so add 13.3% state. And Zuckerberg's total rate is 37.1%. But wait, that 37% only applies to the gain, not the wholesale. So if Zuckerberg sells $300,000 in stock that he acquired for nearly nothing when he founded Facebook, almost the entire amount is gain, so he pays 37.1%, but he doesn't pay Social Security or Medicare tax on capital gains, so his effective rate on $300,000 is 37.1% compared to the engineer's 53%, and Zuckerberg keeps $188,700 compared to the engineer's $140,000, which means Zuckerberg takes home $48,000 more on the same $300,000, or 34% more after-tax income, despite being worth $150 billion and the engineer being worth maybe $1 million. But here's where it gets even more unfair, because Zuckerberg doesn't actually sell $300,000, he sells billions, and at that scale the savings are astronomical. According to SEC filings, Mark Zuckerberg has sold approximately $1 billion worth of Meta stock per year in recent years to fund his philanthropy and lifestyle, and on that $1 billion, he pays approximately $371 million in taxes at the 37.1% rate, which means he keeps $629 million. If that same $1 billion were taxed as ordinary income like the engineer's salary, he'd pay the top federal rate of 37% plus California 13.3%, plus Medicare 1.45%, total 51.75%, which would be $517 million in taxes. So by using the capital gains loophole instead of taking salary, Zuckerberg saves $146 million per year in taxes on his $1 billion annual stock sales. And over 10 years, that's $1.46 billion in tax savings. And this is completely legal. And the engineers who built Facebook and made Zuckerberg's stock valuable are paying higher rates on their salaries than their boss pays on his fortune. What would you do if you discovered that your boss, the CEO of your company, pays a lower tax rate than you, despite being worth 50,000 times more? And that this isn't because of illegal tax evasion, but because the tax code is explicitly designed to favor people who own companies over people who work at companies, and that this loophole will never close because billionaires donate hundreds of millions to politicians to keep it in place. This is the reality for every employee at Meta and every other tech company, and most people don't understand how the qualified dividend and capital gains loophole works, or why they can't use it, even though they own company stock through RSUs. If you're starting to understand that the tax system isn't broken, but is deliberately designed to ensure that founders and major shareholders pay far lower rates than employees, that Mark Zuckerberg paying 37% while his engineers pay 53% isn't a bug, but a feature of the system, and that this is why billionaires keep getting richer while high-earning workers stay stuck, then stay with me, because what comes next will show you the exact legal mechanism of how the qualified dividend loophole works, why you can't use it even if you work at Meta and receive stock, and why this system will never change because both political parties are funded by the billionaires who benefit from it. Subscribe now because very few channels will explain why the people who built Facebook pay higher tax rates than the person who owns Facebook, and understanding this is essential to realizing that you'll never get rich through salary, no matter how high it goes. Here's exactly how the qualified dividend and capital gains loophole works, and why it only benefits company founders and major shareholders, not employees. Under United States tax code, there are two fundamental types of income: ordinary income and capital gains. Ordinary income includes wages, salaries, bonuses, self-employment income, interest, and short-term capital gains, basically anything you earn through work or investments held less than 1 year. And ordinary income is taxed at progressive rates from 10% to 37% federal, depending on how much you make. Capital gains are profits from selling investments that you held for more than 1 year. This includes stocks, bonds, real estate, and other assets. And long-term capital gains are taxed at much lower rates: 0% if you make under $44,000, 15% if you make between $44,000 and $490,000, and 20% if you make over $490,000, plus the 3.8% net investment income tax for high earners. So the maximum federal rate on long-term capital gains is 23.8% compared to 37% for ordinary income. This difference exists because Congress decided in the early 1900s that capital gains should be taxed lower to encourage long-term investment, the theory being that if people hold stocks for years, they're supporting businesses and economic growth, so they should pay less tax than people who earn wages. And this might make sense if we're talking about a middle-class investor who buys and holds stocks in their retirement account. But it makes no sense when we're talking about Mark Zuckerberg, who founded Facebook and held the stock not to support the business but because he owns the business. Here's why the capital gains loophole only works for founders, not employees, and this is the critical point that most people miss. When Mark Zuckerberg founded Facebook in 2004, he received stock in exchange for his work creating the company, and the IRS valued that stock at nearly zero because Facebook wasn't worth anything yet. So Zuckerberg's cost basis, which is what he paid for the stock, is essentially zero. Fast forward to today and Meta is worth over $1 trillion, and Zuckerberg owns about 350 million shares worth roughly $150 billion. So when he sells shares, almost the entire sale price is capital gain because his cost basis was zero, and he pays 23.8% federal on that gain. Now compare this to a Meta engineer who receives restricted stock units, RSUs, as part of their compensation. When those RSUs vest, the IRS treats them as ordinary income. Not as capital gains, even though the engineer is receiving stock. The vesting of RSUs is considered a wage payment. So, if an engineer receives 100,000 in RSUs that vest, they pay 35% federal plus 13.3% California plus 1.45% Medicare, total 50% on that 100,000. And then, if they hold the stock and it goes up and they sell it later, only the gain above the vesting price is taxed as capital gains. So an employee gets almost no benefit from the capital gains rate because most of their stock compensation is taxed as ordinary income at vesting. This creates a system where founders who start companies and hold stock from the beginning pay 23.8% on nearly all their wealth when they sell, while employees who receive stock as compensation pay 50% on the value when it vests and only get capital gains treatment on appreciation after vesting. And this is why Mark Zuckerberg pays 37% total, including California, while his engineers pay 53%, and this disparity is by design. The tax code explicitly treats founder stock better than employee stock, even though both are ownership in the same company. The justification for this is that founders took the risk of starting the company, so they deserve favorable tax treatment, but this ignores that Facebook wouldn't be worth $1 trillion without the tens of thousands of engineers who built the platform. And those engineers are paying higher tax rates than the person who benefits most from their work, and there's no tax provision that recognizes this contribution. If you didn't found the company, you're stuck paying ordinary income rates on your compensation, even if that compensation is stock. Here's the specific part of the tax code that creates this loophole and why Congress will never close it. The qualified dividend and long-term capital gains rates are set in the Internal Revenue Code Section 1H11, and this section has been amended many times over the past century. The capital gains rate has been as low as 0% in the early 1900s and as high as 39.9% in the 1970s, and the current 20% maximum rate was set by the American Taxpayer Relief Act of 2012 under Obama, and before that it was 15% under the Bush tax cuts. Every few years there's a proposal to raise the capital gains rate, or to tax capital gains as ordinary income for high earners. Most recently, Joe Biden proposed in 2021 that people making over $1 million per year should pay ordinary income rates on capital gains, which would have meant that Mark Zuckerberg's $1 billion in annual stock sales would be taxed at 37% federal instead of 20%, a difference of $170 million per year. But that proposal died in Congress and never became law. And the reason it died is because billionaires and their lobbyists donate hundreds of millions to both Democrats and Republicans to ensure the capital gains rate stays low. Markets heat. Zuckerberg personally has donated over $400 million to political causes and candidates over the past decade. This includes $300 million to the Chan Zuckerberg Initiative, which does political advocacy, $70 million to election infrastructure in 2020, and tens of millions to individual candidates. And while Zuckerberg claims he's non-partisan and donates to both sides, the effect of his donations is to ensure that candidates who want to raise his taxes don't get elected, and he's not alone. Every tech billionaire does this. Jeff Bezos, Elon Musk, Larry Ellison, Sergey Brin, Larry Page. They all donate massive amounts to political campaigns and lobbying, and one of the top priorities for their lobbying is to keep the capital gains rate low, because if the capital gains rate were raised to ordinary income levels, these billionaires would pay an extra $200 to $300 billion in taxes over their lifetimes. So spending a few $100 million on lobbying to save a few $100 billion in taxes is an incredible return on investment. And this is why the capital gains loophole will never close. The people who benefit from it control the political system through donations. Let me show you exactly how much Mark Zuckerberg has saved using the dividend and capital gains loophole compared to if he paid ordinary income rates like his employees. And these numbers will prove that this isn't about fairness or encouraging investment, but about transferring wealth from workers to owners. Since Facebook went public in 2012, Mark Zuckerberg has sold approximately $15 billion worth of Meta stock through various planned sales. Most of this went to funding the Chan Zuckerberg Initiative, buying real estate and other investments, and on that $15 billion, he paid approximately $5.7 billion in taxes at an average effective rate of 38%, including California state tax, which means he kept $9.3 billion after tax. If that same 15 billion had been taxed as ordinary income like his engineers' salaries, he would have paid 52%, including federal, state and Medicare, which is 7.8 billion in taxes. So by using the capital gains loophole instead of ordinary income, Zuckerberg saved $2.1 billion in taxes on 15 billion in stock sales, and this is money that could have funded schools, infrastructure, healthcare, or reduced the deficit. But instead, Zuckerberg gets to keep it because the tax code favors capital gains over wages. Meanwhile, the engineers who built Facebook have collectively paid far more in taxes as a percentage of their compensation than Zuckerberg has. Meta has about 86,000 employees, and if we assume an average compensation of 200,000 per year, that's 17 billion in total annual payroll, and those employees collectively pay about 8.5 billion per year in taxes at an average 50% rate. So every single year, Meta employees pay more in total taxes than Mark Zuckerberg has paid in his entire life, despite Zuckerberg being worth 150 billion and the employees collectively being worth maybe 50 billion in total across all 86,000 people. And this disparity exists entirely because of the capital gains loophole that treats ownership income better than labor income. Here are the arguments that defenders of the capital gains loophole make and why every single one is dishonest or misleading. They claim that capital gains should be taxed lower because the money was already taxed at the corporate level, so taxing it again as capital gains is double taxation. But this is false for several reasons. First, the corporate tax rate is 21%, and it's paid by the corporation, not the shareholder, and the shareholder receives the benefit of the stock price appreciation without paying tax until they sell. So, there's no double taxation on unrealized gains. Second, many corporations pay zero corporate tax through various loopholes. Meta paid an effective corporate tax rate of about 17% in recent years, far below the statutory rate, so the double taxation argument is overstated. And third, even if we accept the double taxation argument, why should shareholders get a tax break that wage earners don't get? Your salary is also double taxed. Your employer pays payroll taxes and you pay income tax, but you don't get a lower rate because of it. They claim that lower capital gains rates encourage long-term investment and economic growth, but studies show that most of the benefit goes to the ultra-wealthy who would invest regardless of the tax rate. Mark Zuckerberg isn't holding Meta stock because of the tax rate. He's holding it because he controls the company, and the evidence shows that countries with higher capital gains rates don't have lower investment rates. So the growth argument is unsupported. They claim that if you raise capital gains rates, people will just hold their assets forever and never sell, which reduces tax revenue. This is called the lock-in effect. But this argument actually supports taxing unrealized gains, or taxing at death, not keeping rates low. And the evidence shows that capital gains realizations are not very sensitive to rate changes. People sell when they need money or want to diversify, regardless of the tax rate. The real reason the capital gains rate is low has nothing to do with economic efficiency or fairness, and everything to do with political power. Rich people own most of the capital gains. The top 1% of earners receive 75% of all long-term capital gains, and the top 0.1% receive 50%. So when Congress keeps the capital gains rate low, they're giving a tax cut to the richest people in the country, and those rich people thank Congress by donating to their campaigns, and this creates a cycle where low capital gains rates concentrate wealth. Concentrated wealth buys political influence. Political influence keeps capital gains rates low, and the cycle continues, and workers like the Meta engineers are stuck paying 50%, while the billionaires who own the companies pay 37%. And this gap keeps widening because capital gains have been growing much faster than wages. Corporate stock prices have tripled in the past 10 years, while median wages have grown 15%. So the people who own stocks are getting much richer, much faster than the people who earn wages, and they're paying lower tax rates on their gains, which is why wealth inequality has exploded. Here's what happens when you're a Meta employee and you try to use the same loophole as Zuckerberg, and this will show you why the system is rigged to prevent workers from benefiting. Let's say you're a senior engineer at Meta and you receive 400,000 per year in compensation, split into 200,000 salary and 200,000 in RSUs that vest over 4 years, so you get 50,000 in RSUs per year. When those RSUs vest, the IRS treats the 50,000 as ordinary income, so you pay 35% federal, 13.3% California, 1.45% Medicare, total about 50%, which is $25,000 in taxes, and you receive the stock worth $25,000 after tax. Now, if you hold that stock for 1 year and it goes up 20%, so it's worth $30,000, and you sell it, you pay capital gains tax on the $5,000 gain, which is 23.8% federal plus 13.3% California, total 37%, which is $1,850 in taxes, and you keep $3,150 after tax on the $5,000 gain. So on the original $50,000 RSU, you paid $25,000 when it vested plus $1,850 on the gain, total $26,850 in taxes, effective rate 53.7%, and you kept $23,150. Compare that to Mark Zuckerberg selling $50,000 in stock that he got when he founded Facebook. He pays $0 at vesting because he didn't receive it as compensation, and he pays 37% on the full $50,000 when he sells, which is $18,500, and he keeps $31,500, which is $8,350 more than you on the same $50,000, all because he founded the company and you work there. This example shows that even when employees hold stock and get capital gains treatment on appreciation, they still pay far more than founders because the initial stock compensation is taxed as ordinary income, and there's no way around this. The IRS rules are clear that RSUs are ordinary income at vesting, and only founders who received stock at formation get the full benefit of capital gains rates. So the system is explicitly designed to favor founders over workers, even when both own stock in the same company. And this is why you can't replicate Zuckerberg's tax strategy. Even if you work at Meta and accumulate millions in stock, you'll still pay 50% on most of it, while he pays 37%. The final piece that makes this system permanent is that both political parties benefit from keeping the capital gains loophole in place. Democrats claim to support taxing the rich, but when they have power, they don't actually raise capital gains rates significantly. Obama had control of Congress in 2009 and 10 and didn't raise the rate. Biden proposed raising it in 2021, but didn't push hard when it failed, because Democrats receive massive donations from tech billionaires and venture capitalists who all benefit from low capital gains rates. Silicon Valley donates heavily to Democrats, and those donations come with an implicit understanding that capital gains rates won't go up. Republicans openly support low capital gains rates as part of their pro-business ideology, so they'll never raise them, and this means no matter which party controls government, the capital gains loophole stays in place, and Mark Zuckerberg keeps paying 37% while his engineers pay 53%, and the wealth gap keeps growing, and workers keep falling further behind no matter how hard they work or how high their salaries go. Now you understand exactly how Mark Zuckerberg pays a 37% effective tax rate on $150 billion, while Meta engineers pay 53% on $300,000 salaries. It's the qualified dividend and long-term capital gains loophole that taxes investment income at 23.8% federal versus 37% for wages. And you understand why this loophole only benefits founders who received stock at formation, not employees who receive stock as compensation, because RSUs are taxed as ordinary income at vesting, while founder stock is taxed as capital gains when sold. And you understand that Zuckerberg has saved over $2 billion in taxes using this loophole compared to if he paid ordinary income rates, while his 86,000 employees collectively pay more in taxes every single year than he has paid in his lifetime. And you understand that this system will never change because billionaires donate hundreds of millions to both political parties to keep capital gains rates low. And you understand that this is why wealth inequality keeps accelerating, because the people who own companies pay lower rates than the people who work for companies, and capital gains grow faster than wages, so the owners get richer faster and pay less tax. And this gap is permanent unless there's a political revolution that eliminates the capital gains preference. But that won't happen because the people who benefit from it control the political system. So Mark Zuckerberg will keep paying 37%, Meta engineers will keep paying 53%, and the system will keep transferring wealth from workers to owners. If this explanation of why Mark Zuckerberg pays a lower tax rate than the engineers who built Facebook has made you understand that the tax system is deliberately designed to favor owners over workers, That this isn't a bug but a feature of how capitalism concentrates wealth, that you'll never get rich through salary, no matter how high it goes, because salary is taxed at 50%, while capital gains are taxed at 37%, then you need to see what we reveal next, because the qualified dividend loophole is just one of many ways billionaires avoid taxes. Subscribe now and prepare to discover how Elon Musk borrowed $88 billion tax-free while you pay 37% on your salary, how Jeff Bezos paid a 0.98% tax rate on $100 billion in wealth, how Bill Gates avoids $10 billion in estate taxes using his foundation, and how the carried interest loophole lets private equity billionaires pay 20% on billions while you pay 37% on salary. Because once you understand the complete picture of how the tax code is rigged to ensure billionaires never pay their fair share while workers are taxed to death, you'll understand why wealth inequality has exploded to levels not seen since the Gilded Age, why the American dream is dead for wage earners, why your children will be poorer than you despite working harder, and why this system will never change through voting, because both parties are funded by the billionaires who benefit from it. So the transfer continues, the loopholes stay open, and Mark Zuckerberg keeps paying less than the people who work for him.